Welcome back to the Building Equity Podcast. I'm James Schlimmer.
And I'm John Bowens.
Oh man, we've got such an amazing show. What's actually happening in the U.S. housing market? A new real estate investor's guide in 2022, and we're sitting down with Jason Hartman, John.
And you know what I'm so excited about Jason is how he puts things into perspective in relation to other commodities and other asset prices. You know, one of the common questions that I'm getting right now is, why should I consider investing in real estate when asset prices are so high? And I think it's important to understand the metrics behind real estate, looking at cash flow, looking at asset prices in real estate versus other hard assets. And Jason, I think, does a great job talking about housing prices in relation to gold, in relation to oil, in relation to other hard assets, as he refers to as having intrinsic value.
Yeah.
Somebody that's been in alternative investing my entire career, close to 20 years now, we look at hard asset investing in real estate, investing in gold and silver potentially, investing in land, notes and mortgages that are secured by real property, investments in private businesses that have intrinsic value, intrinsic assets. So that's why I'm so excited about.
We got him. He's coming on our show.
Let's jump into it.
Today it's going to be good. But before we do that, we got to give a disclaimer. We're not allowed to give any financial advice. We're not giving you any investment advice. What are we doing, John?
We are giving information and education. That's what we do here on the Building Equity Podcast.
And all of that is brought to you today by IRA Title Pro. So if you are using your self-directed IRA to buy and sell real estate, you need to know about IRA Title Pro. Head over to IRATitlePro.com. Take a look at the site. We've got an amazing closing team, national title company. We can close 11 days faster. And guess what, John Bowens?
What?
We've got resources that your investors can use every step of their journey when they're buying, selling, or lending. So whether they want to research properties, whether they want to run short-term estimators, whether they want to know their closing costs in advance, whether they just want to look at macro-level data in the real estate industry across the country. We've got foreclosure metrics. We've got single-family home metrics. We've got it all, buddy.
James, and I'll mention to all of the Equity Trust viewers or other folks out there that have a self-directed IRA, whether you're looking to buy a property or sell a property. So for those of you that have existing real estate in your self-directed IRA, you're looking to sell the property, or if you're brand new with a self-directed IRA looking to purchase a property, I'd encourage you to check out IRA Title Pro. James has built an amazing program, an amazing team, and really understands self-directed IRA investments, whereas not all title companies, not all closing attorneys understand self-directed IRA custodians like Equity Trust and understand the self-directed IRA closing process. So again, check out IRATitlePro.com.
You know what you just did? You gave me goosebumps. That was wonderful. I don't even know what to do, but I tell you what, enough about me. Right? And enough about you. The whole day you're talking about yourself. Let's bring Jason Hartman to the show. Let's talk about him. Come on, let's do it. You ready?
I'm ready.
All right, let's do it. We're back here on the Building Equity Podcast. John, I couldn't be more excited to have a legend, probably one of the best real estate coaches in all the business here on our show, Jason Hartman. Jason, thank you so much for joining us.
Hey, it's my pleasure. Good to be here.
I got to dive right in. The first question, are we in a correction or a collapse? What's happening here?
Well, that is the trillion-dollar question that everybody keeps asking. And just to give a little spoiler alert here, I do not think we are in for a market crash. However, we are definitely going into a recession if we're not in one already. The Fed is doing everything they can to stop inflation. I think they've just played this very poorly. They let the economy run way too hot for way too long. They should have raised interest rates much sooner and more gradually. They didn't. We're in a centrally planned economy. So look, we have what we have. And now they've acted too suddenly and it's shocking the market. And the idea of a soft landing is probably not going to happen.
So when you hear the question, Jason, I don't mean to cut you off here, but we hear, hey, inventory over the last 3-4 months, it's skyrocketing. What's your...
Yeah, that's just not true. Inventory is still historically low, and I'd be happy to show you some charts on that. It is higher than it was before, but it is, historically speaking, very, very low. There's no question about that. We have about 561,000 homes for sale in the United States right now, And any expert you ask would say that normal, a quote unquote normal market, would be 2 times that, maybe about 2.5 times that amount, depending on who you ask. And that would leave us with approximately 6 months of inventory at current absorption rates. And we have a very unusual situation going on right now because we have people that own properties already that have incredibly cheap mortgages. This really may have never happened before. I don't know. I can't think of a time, at least in the last 5 decades, when it's happened. And they've got these incredibly low, artificially cheap mortgages. 25% of the country has mortgages under 3%, if you can believe that. 40% of all homes in the United States are paid off free and clear. Those people are not going to be under any distress, right? And to have a crash, you need a distressed owner, a distressed seller. And the vast majority of the country has got a very good deal. Now, I said before that 25% of the country had mortgages sub 3%, but let's take it up a little bit from that. And unfortunately, I don't have numbers on this, but you can just kind of take educated guesses yourself. How much more of the country has a mortgage below 3.5%, or below 4%, or below 4.5%, or below 5%? Those are still very low rates and very affordable mortgages. So the idea that there's going to be some big crash, there's no evidence for it yet. That evidence may come in the future, but right now, not even close.
I love when I listen to you, because typically what you'd say is, compared to what is the magic question, right? And I agree with you 100%. While we got you here, is it possible you can give us the top 3 mistakes you see entry-level, intermediate-level real estate investors make?
I think the first mistake is that they don't invest. They find all sorts of justifications and reasons. They try to time the market, and in any asset class, whether it be stocks, bonds, precious metals, cryptocurrency, market timing has just historically been proven to be a bad idea. Okay, the people that win the game are the people that make smart, value-oriented decisions, and they buy and they hold the asset. Now, I'm not just talking about real estate. I'm talking about any asset. And, you can look at any kind of market and you can see that has been true over and over again. So the fact that they don't invest because they're trying to time the market. Let me give you an example of that. Let's look back to 2008 and the Great Recession. That was an anomaly. It's something that happened once in 7 decades. We never saw that kind of economy before in any of our lifetimes. So we had the Great Recession, right? And coming out of the Great Recession, people saw prices rise. And they all started to get worried as prices kept going up, saying, hey, this has got to be a bubble. This has got to be the peak of the market. I'm going to wait until the market cools off, and I'm going to preserve my cash, and I'm going to go in and buy. Guess what year they were saying that? 2014, 2015. And guess how they did? And then they said that all along, right up until 2020, and then the pandemic came along, and everybody thought that was the end of the world. And what a lot of people just forget is that we are in a centrally planned economy. And as such, the central planners react to the market, right? It's not just a matter of supply and demand and basic economic fundamentals. When things get bad, the Fed makes changes, they make adjustments, and the government does the same thing. And so people who in 2020 were thinking COVID is the end of the world, they didn't do anything. And look what happened. They lost 40% appreciation in some places. So they just completely missed the boat on that. So the thing you've got to do is make smart decisions and buy. Here's what investors do. They invest.
Makes perfect sense.
Investors invest. Okay. And think about this too. If you keep your money sitting on the sidelines, it is guaranteed that you will lose officially 9% a year just to inflation, and unofficially, because the consumer price index is massively understated and it's a farce, you'll probably lose 17%. So if you have $100,000 or $1 million that you've just got in cold hard cash, you're going to lose $17,000 a year on the 100,000, or 170,000 on the million by inflation, right? So you've got to get that money deployed. That's the important thing to do, is to be in the market, but you got to do it smart. And I'll just share my screen and share a couple of things here that might be helpful to the listeners. First of all, to understand the value of anything, you've got to have the right measuring stick. And so let's talk about that measuring stick. Most people have these huge blind spots because they're using the wrong measuring stick. In fact, they only use one measuring stick, and that is the US dollar. They compare the value of real estate to one thing, the US dollar. And the US dollar is a moving target. Obviously, it's constantly being debased by inflation, right? So that would be a huge mistake. So we've got to compare it to more things to understand the real value. There are three basic types of markets: linear markets, cyclical markets, and hybrid markets. And they all act very differently. The linear markets, those are the markets we like and smart investors like. These are slow and steady and profitable markets. A lot of them are in the Southeast, the Midwest, those kinds of places. The cyclical markets, these are the roller coaster markets. They're the markets that get all the attention: the West Coast of the United States, the expensive Northeastern markets, and South Florida, where I live. And then hybrid markets are in between the two. When you hear about real estate prices and you listen to one of the most commonly cited indexes of real estate prices, the Case-Shiller Index, you have to understand that that contains only 20 metro areas, and 15 of the 20 are cyclical markets. Wow. 2/3, right? Or sorry, 3/4 of that index is cyclical. Only 25% or a quarter is linear. So there's just too much attention paid to cyclical markets, not enough attention paid to linear markets. And the cyclical markets in this phase that we're in are suffering the most, and I believe they will continue to suffer the most. Let me give you an example of these, okay? It's really easy when you look at a chart. So this is Memphis, Tennessee. Since the early 80s, this is a chart of appreciation and depreciation. And you can see that Memphis is pretty slow and steady. It's pretty linear, right? That's why it's called a linear market. Yep. And we've helped hundreds of investors buy properties in Memphis. Great rental properties. I've owned many there myself. Good market. Indianapolis, another place that we've helped hundreds of investors buy properties. Another boring linear market. Minor ups and downs, but again, nothing too exciting, nothing the news media would be very interested in. Contrast that to where I grew up, Los Angeles, California. Wow. And look at this. It's a roller coaster of glorious highs and really ugly lows. And then it goes up, then it goes down, then it goes up and down. And it's just absolutely crazy, right? This is a roller coaster cyclical market. So we recommend the linear markets. Okay, and that compared to what question that you mentioned is so important for everything we do in life, is to compare to a lot of things so that we can understand the value of anything.
Awesome.
And Jason, question for you. I really appreciate you pointing out you have to look at the specific market. You can't just look holistically, from a macro perspective. And that's what this Building Equity podcast is all about, is showing investors how to look specifically in their individual market. So we know that the National Association of Realtors is saying, okay, valuations are up. I think they are saying year over year, 1%. Yet we have very large institutions like Morgan Stanley, Goldman Sachs, and some others that are saying, well, no, our prediction or what we're seeing in the data we're looking at is saying 5 to 10%.
Moving into the future over the next year, they're saying you're going to see a 5 to 10% drop in valuations.
Over the next year. Jason? How do you look at that type of data, and where should viewers be looking for data, whether it's on a macro level or a micro level?
Well, that data is very skewed because it's all lumped together. Look, in a country as large and diverse as the United States, we have almost 400 what they call MSAs, or metropolitan statistical areas. We have over 3,100 counties. We have over 9,000 cities. And according to Obama, we have 56 states. Okay, had to throw that in.
Well said.
You just can't lump those all together. The old saying in real estate is all real estate is local. So to answer your question, the place to really look to understand what's going on is the index that I created because it takes a much more accurate view of things. I call it the Hartman Comparison Index, or the HCI. And what this does is compares the price of real estate over the last 52 years to a whole bunch of things, a whole basket of things, things that have intrinsic value, that are not attached to any one currency, and things that every person on earth needs to live. So that's what I can take you through, just a couple of examples of the Hartman Comparison Index. I think it'll be very enlightening, and it'll answer that question of, when will the bubble pop, if it will at all, right? I teach another strategy that I don't have time to go into today called packaged commodities investing. And I think that commodities are really the thing you all want to look at all the time, because commodities have intrinsic value. Lumber, concrete, copper, petroleum products, right? These things have intrinsic value. It doesn't matter if you trade them in the yen, the euro, the dollar, the peso, the Brazilian real. Doesn't matter. They all have intrinsic value, and they're traded worldwide. They're needed by everybody. And I also teach another great strategy called inflation-induced debt destruction. I would highly encourage anybody watching or listening to this to check out my podcast or my YouTube channel to learn more on these strategies, because they can really, really help to make good investment decisions. But let's look at the first item in the Hartman Comparison Index, and that is gold. Now, I'm not a gold bug, but there's no question that billions of people on Earth consider gold to be money, and they have for thousands of years. So let's compare the price of houses to gold. Okay, now up until 1971, we were on a gold standard until Nixon took us off of it in 1971. And the gold price was pretty much controlled until then. But let's just look at a couple of examples here. Let's go back to 1970. And the median price house was $23,000. Gold was $35 an ounce. If you wanted to buy the median price house, you would need 654 ounces of gold. Just 10 years later, as we had all this inflation from the 80s, the median price house tripled almost to $63,000. The gold price went way up to $653, and it would only take 97 ounces of gold to buy the median price house. Now, let's fast forward a bit. Let's go to, say, 2010, okay? Because then we're just kind of coming out of the Great Recession. The median house price is $171,000 essentially. Gold is a little over, it's almost $1,100 an ounce. It would take 158 ounces of gold to buy the median price house. Today, the median price house is $390,000. Gold is about $1,700 an ounce. It would take 227 ounces of gold to buy the median price house. So look at this. Priced in gold, houses are cheaper than they were 3 months ago by 1 ounce. Not much, I get it. They're definitely way cheaper than they were in the year 2000, because in the year 2000, you'd have to have 520 ounces of gold to buy the median price house. And, back in 1990, 32 years ago, you'd need about the same amount of gold as you need today, right? The dollar is a moving target. It's a bad comparison. It's one comparison, but it's only one of many. Okay, so priced in gold, is housing cheap or expensive? Well, what's the answer? It's certainly not the cheapest it's ever been, but it's also not the most expensive it's ever been. Now, let's look at oil. Oil is, a hugely important commodity, arguably one of the most important commodities in the world. No matter what the greenies say, the world runs on oil, okay? Back in 1970, that $23,000 median price house priced in oil at $4 a barrel, which is the price back then, it would cost 6,400 barrels of oil to buy the median price house. 10 years later in 1980, the house price almost triples. Oil is way up to $37 a barrel, and it would take 1,700 barrels of oil to buy a house. Now, people might be thinking, well, Jason, I don't denominate my life in gold or oil or any of the other commodities in the Hartman Comparison Index. But you have a choice. And a lot of people make these choices, even if you don't. When they get paid every 2 weeks or every month, they do something with their extra money. They either put it in the bank and in a savings account, or they buy stocks, or they buy commodities like these things, and they decide on a way to store their wealth until they save enough for a down payment on a house. So if you save it in dollars, you can see that over time, you're definitely going to lose by inflation, right? You're not going to keep up with inflation. So it's better to have it in things than currency units. Let's go to today. So oil, or the house, is about $390,000, oil approximately $94, 4,100 barrels of oil to buy the median price house today. So is it cheap or expensive in oil? Well, let's just look at the right-hand column here. I mean, it's pretty cheap, actually. You know, it's not the cheapest it's ever been, certainly not the most expensive either. So priced in oil, not that bad either. We can look at rice, which is the food stock of, more than half the world. And priced in rice, housing is actually quite cheap today. And we can keep going. We can price it in shares of the S&P 500 index. Priced in the S&P, housing is actually very cheap. It's only 98 shares of the S&P to buy the median price house. Okay. Back in 1970, it was 249 shares of the S&P to buy the median price house. In 2010, it was 136 shares. So priced in shares of the S&P, is housing cheap or expensive? It's actually pretty cheap. Not the cheapest it's ever been, but pretty cheap. Thoughts?
I'm blown away right now. I've never thought in a million years to equate the valuations of homes and what your question, John, to Jason, and he queued up, compared to what? Hey, is it expensive compared to gold, oil, rice? And you start to get a chance to see.
And we've got over 40 things in the index.
Oh, wow.
Okay, so.
Can you talk a little bit, Jason, very quickly? I want to be courteous of your time, but when folks sign up for coaching under Jason Hartman, what should they expect? What does it look like? And obviously, it's a unique way of looking at the markets that is brilliant, to be honest with you. But can you talk a little bit about that, and then talk about your upcoming conference?
Yeah, so typically people just listen to my YouTube channel or my Creating Wealth podcast. And then a lot of times they reach out to our investment counselors who offer free investment counseling on how to build a real estate portfolio. And then if they want something more formal, they can sign up for one of our more formal programs like our Empowered Investor Pro membership or our formal coaching program. And then we've got a conference coming up in Scottsdale. It's a 2.5-day conference at a beautiful resort location at the end of January. People can go to jasonhartman.com, my main website, for tickets on that. And, join us for that. We'll have lots of great speakers, lots of great exhibitors, and it'll be a really fun time. We always have a band. We have a lot of fun. We have cocktail parties. People say it's like the funnest thing they did all year when they come to our conferences. So join us for that.
Thank you so much,
Get your
Jason.
tickets at jasonhartman.com.
Thank you so much for that. And listen, I'm in South Florida, so I'm in Naples. And I heard your opinion on this. But when a hurricane comes and devastates a state, you get a lot of folks that say, oh my goodness, the real estate market in the state of Florida is completely going to collapse. And what says you, Jason?
Oh, they're usually completely wrong. It's usually the reverse is true. And listen, I've watched it over the years many, many times. First off, we've got to realize we're talking about commodities, right? We talk, when you look behind, I'm in my house, right? And I live in Palm Beach, Florida. So behind me and above me and below me, what do you see? You see drywall, you see lumber, you see steel, you see brick, you see concrete. In front of me, you see glass and steel. And in the walls, you see copper wire wrapped in, petroleum products, right? The insulation for the wire. All of these commodities have intrinsic value. And whenever there's a natural disaster, commodities get destroyed and there's more demand to buy more commodities. And then some housing stock gets destroyed. And so you've got actually more demand in that area because all kinds of construction workers, contractors, insurance estimators, they have to move into that area and live there for a year or two to handle all of their business and their construction there, right? So I remember when Katrina hit in 2005, and I visited the affected areas in the Gulf Coast, Alabama, Mississippi, Florida, and the opposite was true of what everybody said. People got paid their insurance claims. Many times they had to fight with or sue their insurance company. Sure, I get it. But then a lot of times they didn't even rebuild their house because by the time they settled their insurance claim, or even before that, some big developer came along and did what's called an assemblage and bought a bunch of houses and built a high-rise condo or some new development there and made them a huge offer they couldn't resist and refuse. So it's just, people just don't get it. After that last hurricane, people were calling me, emailing me saying, hey, there must be great opportunities. It must be a fire sale. No, the opposite is true. You don't get it. And just think about the market dynamics. Now, granted, if everybody did leave the state of Florida, yes, that would be bad news, but the opposite is true. I mean, people are moving into Florida like crazy.
I 100% agree with you. Jason, want to be courteous of your time. Thank you for joining John and I in the Building Equity Podcast. Again, if you're brand new to real estate investing, head over to jasonhartman.com. Take a look. If you can hear Jason speak anywhere throughout the country, go to his conference. He has an unbelievable perspective on this. I don't think there's anybody better in the business than this guy right here. And I don't say that lightly. So.
Well, thank you. I appreciate the compliment. And what we try to do is we try to just really do our own research and come up with really unique strategies. These ideas, all of my techniques, not just the Hartman Comparison Index, they came out of my own head. Okay, I've been to all the conferences, I've read all the books, but these are unique ideas that people aren't hearing anywhere else except maybe by my competitors who are copying me, but that's just the way business goes. But they'll really get some unique strategies at our Empowered Investor Live conference. So go to jasonhartman.com, join us for that. And thank you for having me, and happy investing to everybody.
Awesome. Thank you so much, Jason. You have a wonderful day, all right?
You too. Bye-bye.
All right, bye. How about that, John Bowens? We just had Jason Hartman on the Building Equity Podcast. We're only in season 2. We're landing literally, I would say, I'm not blowing smoke, I think he's one of the finest real estate investing coaches in the nation. And he was here on the Building Equity Podcast talking to our investors. What'd you think?
I think it's, what's important for our viewers is bringing folks into the show that have been through many different market cycles, right? So there's some folks, I watch a lot of, I subscribe to a lot of podcasts and, other articles, and some of the folks I see, they've only been through maybe 1 or 2 market cycles themselves. One, if they're lucky. And what I find is, yes, we can look historically, but there's nothing that makes a difference than for someone that has actually lived it, right? If you're a real estate investor and you've lived through multiple market cycles with assets, that's the big difference maker. And that's what we try to bring to this show, is people that have been through those multiple market cycles, have been through the good times and the bad times, and really can speak to it from a practitioner perspective.
The eye-opener for me was Memphis, linear growth, easy, right? He goes into Indiana, or Indianapolis, right? Linear.
Yeah.
And then he shows Los Angeles. And you're just looking at this and like, why would you as an investor subject yourself to that volatility?
Yeah. Let's talk about that, James, for just a second.
Sure.
To conclude this call. So he talked about 3 different markets, right? So the first one was
Memphis.
Right. But the 3 different types of markets, I should say, the dynamics of the market. So the first one was linear.
Yep.
So that was the Memphis.
Yep.
And then the other one was, what was the other one? Do you remember what the second one was?
I thought we were
Indianapolis.
in Indianapolis. Yeah.
Indianapolis. Okay, so those are the 2 examples. Now, I'm sure that there's plenty of other metropolitan cities or other locations across the country that have similar linear markets. The second one was cyclical. The example he used was Los Angeles.
Yep.
I'm sure we could probably pull up Boise, Idaho. We could probably pull up Austin, Texas. We could probably pull up maybe some cities in Florida,
Yep.
but generally speaking, I think Florida would probably show more of a linear line. And then the last he showed was a hybrid. So I think that's interesting looking at, and we didn't get a chance to get into it, but maybe for a future episode, we could look at some of those hybrid markets. Because if you think about it, there might be a lot of people that are able to predict those linear and cyclical, but those hybrid ones might be a little bit more difficult, which could be a great opportunity for investors.
I've been around the world. I've been to conferences. He's a legend.
Mm-hmm.
You know what else I think is a legend?
James Schlimmer.
No. John Bowens joining here in the studio. for season 2 of Building Equity Podcast. So I'm looking forward to the next episode. I'm looking forward to sitting down with some of the real estate, the best that the real estate industry has to offer. And that's what we want to be able to do here, is help our investors get to the next level, right?
Get to the next level. And again, it's all about providing information and education. There's a lot of, I think, hype out there. There's a lot of, get rich quick type programs out there. We're not here to sell any type of education. We're here strictly to inform investors on how they can get started with investing in real estate, or if they're already involved in real estate, how they could potentially take it to the next level, whether it's with a self-directed IRA or outside of a self-directed IRA.
Couldn't have said it better myself. Real quick, tell the viewers, are you a high sock, athletic sock guy, or do you wear the low ankle socks?
Depends on the day of the week. Weekends, I'm
Wednesdays.
more...
What do you wear on Wednesdays?
Wednesdays, I'm wearing high socks.
High socks.
Yeah.
There you have
Yeah.
it. Looking forward to the next episode. Thank you for being here, John.
Thank you, James.